Good afternoon, everyone. Hope you all are doing well. On behalf of NISM, I take this opportunity to welcome you all and introduce today's speaker, Dr. Aparna Bhatt, for this webinar on significance of equity derivatives. Briefing about Dr. Bhatt, she has total work experience of 26 years, till date of which 14 years are spent in the corporate sector in various areas such as audit, finance and accounts, and risk management. She is currently an associate professor in finance with KJ Somaiya Institute of Management, where she facilitates a course on derivatives and financial risk management. Before joining KJ Somaiya, she led the risk management team at NSC. On the academic front, Dr. Bhatt is a chartered accountant and holds financial risk manager certification from Global Association of Risk Professionals, that is GAR, USA. In addition, she holds a postgraduate diploma in Treasury and Forex Risk Management from ICFAI. Her doctoral research explored the efficacy of alternative models for pricing of exchange-traded currency options in India, and her research interests are in the areas of financial markets, derivatives, and financial risk management. She has also published many research papers in reputed academic journals and has presented her research at many national and international conferences. We are glad to have you, ma'am. Over to you. Thank you.
Yeah. Thank you, Kiran, for that kind introduction. And with that, I think I will start with my presentation. So we are here to understand the significance of equity derivatives. So the topic is the equity derivatives NISM series 7 exam that we are going to look at. So before that, let me just start sharing my screen. And yeah, I hope the screen is visible.
Yes, ma'am.
Okay. So let me start right away with the significance of equity derivatives. Now, so before we plunge into understanding what are derivatives and all that, so let's look at 3 different examples. Okay. So I will start with the case of a retired person, Mr. Sharma. He is a retired individual and he has investments in equity shares of Indian companies, equity and debt mutual funds, and some bank deposits. And Mr. Sharma's worry is that, let's say, elections are scheduled over the next month, and he is worried about the results of the forthcoming elections. And you know that in India, if no clear mandate is given to any political party, then you know that invariably what happens is that the stock market takes a fall, right? So Mr. Sharma is worried that if the results of the elections are not very clear, then that might lead to uncertainty in the stock market, and that may have an adverse impact on his own equity investments, right? So how should he deal with this uncertainty? So what are the options available to him? He can sell all his equity investments, convert everything to cash and sit on the cash, or he can do nothing and wait for the outcome of the elections. Or is there anything else that he can do? Okay, so that is the case of Mr. Sharma. Now let's look at another case. Okay, so Yamini is a media manager for a large corporate house, and she has investments mainly in bank fixed deposits and gold. But recently she has started following the financial news. Okay, so one of her friends has told her that the stock market is a good place to invest in. So she has recently started reading some financial newspapers, following some financial websites, etc. And she has come to the conclusion that the stock market may start rising sharply this month. So note that Yamini has no equity investments right now. Okay, all her investments are in bank fixed deposits and gold. Okay, but one of her fixed deposits will mature by the beginning of the next month. And so she will have some money in her hands. So now she plans to invest that money in equity shares. Right? So what is her plan? Her plan is to start investing money in equity shares starting by the beginning of next month. So what is the risk to her plan? Can somebody tell me what is the risk in her plan? If she starts investing only next month? Yeah, the risk, as somebody is rightly saying, the risk is that by the time she is able to invest, it's quite possible that the stock market may go up quite a bit. Okay. And if the stock market goes up over the next 1 month, then what will happen? Yamini will end up buying her equity shares at much higher prices than today, right? So that is the risk. So how should she deal with this situation? So ideally, she would like to invest today itself. But the problem is that she doesn't have money today. She's going to receive money only at the beginning of the next month. So how should she handle this situation? Should she borrow money from a friend and invest it in equity shares today? Or again, should she do nothing but wait till her FD matures and then she has money in her hand? Or can she do something else? Right? So again, 3 alternatives available to Yamini. So that's the second story. And now let's look at the third case. Okay. So Arjun is a young postgraduate. He has just finished his studies and he has landed a job with a startup. Now, unlike Yamini, Arjun is deeply interested in the stock market. Okay. He uses technical analysis and he also reads all financial news, etc. And his technical analysis tells him that the stock market may rise substantially this month. Okay. Now, since he has just started working, he does not have much money to invest. So although he has a clear view, what is his view? His view is that the stock market may rise substantially this month. But unfortunately, because he has just started working, he does not have any savings and all to invest. He doesn't have much money to invest. Again, how should he deal with this situation? Again, can he borrow money from a friend for investing? Should he do that? Or again, should he do nothing but just wait and watch, and then wait till he has accumulated sufficient savings and then start investing? Or should he do something else? Right? So again, in all these cases, we are dealing with, cases where the investor can't take a decision today. Okay. But it all depends on what can happen in the future. Okay. So buying or selling stocks today is not an option, right? Because in Mr. Sharma's case, we said that he's worried that the market may start falling over the next month. And Yamini and Arjun think that the market may start rising over the next month. So buying or selling today is not a viable alternative, right? Because all the action is going to happen over the next 1 month. So we need some instrument which will enable them to, act on their views for the next 1 month, right? So derivatives is such an instrument. Okay. So how does derivatives become a solution in these cases? So what is common to all these situations? The common factor is that Mr. Sharma is worried about a fall in stock prices in the future, that is over the next 1 month. Yamini, she is at risk from a rise in stock prices in the next 1 month. And Arjun wants to take advantage of a rising stock market over the next month, right? So can we resolve these questions by buying or selling shares today? So buying, selling shares today is not the answer, because what they are thinking of is what will happen in the future over the next 1 month. Okay, so in such cases, we can use financial derivatives as a solution to these problems. So what Mr. Sharma, so now I'll just give you the answer to these questions. What Mr. Sharma can do. Mr. Sharma is worried about a fall in stock prices over the next 1 month. What he can do is, he can either buy put options on the Nifty or Sensex, or he can enter into a short position in Nifty or Sensex futures. Okay. And doing either of these things will help him protect his portfolio against a decline in the market. What can Yamini do? She could either buy call options or enter into a long position in Nifty or Sensex futures to protect against the risk of a rise in the stock market, because she's going to get her money only next month and she's going to start investing only next month. So she is susceptible to a rise in the stock market. To hedge against that, she could either buy call options or enter into a long position in the index futures. And thirdly, Arjun doesn't have any money now, but he wants to make a profit in case the market rises over the next 1 month. So he could either buy call options or enter into a long position in Nifty futures or Sensex futures, right? So by doing these, so what are all these options? Call options, put options, Nifty futures, Sensex futures. What are all these? These are derivative contracts. Okay. So now let's see what are these derivatives. So what is the meaning of derivatives? So I've just given you examples of derivatives. Okay, somebody is asking on the chat, is there no risk? So I'll come to the question of risk. So let's first understand the meaning of derivatives. Okay, I'm going to cover the risks and everything in my presentation. So what is the meaning of derivatives? Okay, derivatives are financial instruments and they derive their value from one or more underlying assets. Okay, and what are these underlying assets? Underlying assets could be metals or energy resources or agri commodities, or they could be financial assets like equities, foreign exchange, and bonds. So derivatives are basically legal contracts with predefined contract specifications. So what are derivatives? They are neither an asset nor a liability. Many times, people say, are derivatives assets? What do you call an asset? Equity shares in a company that you hold, they are assets. Okay. If you hold any real estate, that is an asset. Okay. Or if you own a house, a residential property, that is an asset. If you hold gold, that is an asset. Derivatives by themselves are not assets. What are they? They are simply contracts. What do you mean by contracts? They are agreements. Okay. And they are agreements to do something in the future. Okay. They are agreements to buy or sell something in the future. Right? So derivatives by themselves are not assets, but they are contracts which are written on some underlying asset. And these assets could be, like what we said, metals, energy, agri commodities, and so on. And they have predefined contract specifications. Okay. So normally, when we look at a contract, okay, so let's say you go to buy a house, you go to a builder to buy a new residential flat. So normally you sign an agreement with the builder, right? With the developer. It's a huge, big agreement, 200, 250 page long agreement, right? So, and then you have to sign on several places and you have to register it and you have to pay the stamp duty, etc., etc. So normally what happens is that in such a contract, who decides all the terms and conditions? The developer will write all his terms, conditions, etc., and you just get to sign on it. Okay. So in derivatives are also contracts. Okay. And the equity, like, again, there are two kinds of derivatives which we are going to look at. The first kind is the exchange traded derivatives, and the second are the derivatives which are traded on the OTC market, right? So in case of exchange traded derivatives, the contract specifications, what do you mean by contract specifications? All the clauses, the terms and conditions in the contract, right? So these contract specifications are decided by the exchange on which the derivatives are going to be traded. Okay, but these are all legal contracts. So what are these contracts, derivative contracts? They allow the buyer and the seller of the contract to buy or sell the underlying asset at a predetermined price on some future date. Okay, so there are some derivatives such as futures and options. Okay, now we'll come to what are the different types of derivatives, right? So very common examples of derivatives are the futures contracts and option contracts. And these are contracts which allow the buyer, the parties to the contract to buy or sell the underlying asset at a predetermined price on some future date. And there is another contract which is known as the swap or the swap. The swap contract allows the parties to exchange the cash flows from the underlying asset on some future date. Okay, so basically what are derivatives? They are contracts on some underlying asset and they allow the parties to the contract to buy or sell the contract, or to exchange cash flows on some future date. What are some important features of these derivatives? The value of the derivatives changes with the value of the underlying asset. So the reason they are called derivatives, okay, the reason they are called derivatives is that their value is derived from changes in the value of the underlying asset. Okay, so if the value of the underlying asset rises or declines, then accordingly the value of the derivative will also rise or decline. All trades and derivatives are settled on a future date. Okay, So derivatives are contracts to do something in the future. Okay. So now we should understand there are two kinds of markets. There is something called a spot market and there is something called a forward market. Okay. Now, what is the spot market? Spot market is the market for buying or selling something today. Okay. So basically, if you walk into a, let's say, a car showroom, okay, and you book a car and you buy it then and there, okay, that is a spot transaction. Okay. But suppose you go to the, that means what you are doing, you are entering the car showroom, you are looking at different cars and you are making a full payment immediately and you are getting the keys of the car. Okay. So full payment is made today and delivery of the car is received today itself. That is a spot transaction. That is a transaction in the spot market. But suppose you walk into the car showroom and you say that, okay, you look at a number of cars and then you pick one car and then you tell the dealer, yeah, I like this car, but I will have to arrange for a vehicle loan. I don't have the full money now. So let's say you pay 1 lakh rupees today. Let's say the car costs 10 lakhs. So you pay 1 lakh rupees today and then you tell him that I'll arrange for a car loan, etc., etc. And then I'll come back within 15 days. After 15 days, I'll come back with the remaining money and then you deliver the car to me. Okay. So this is an example of a forward transaction. Okay. Forward transaction as in you are deciding the price of the car today itself, but you will receive the delivery and you will make the payment only after 15 days. So this is a forward transaction. Okay. So what are derivatives? They are contracts which are settled on the future date, right? So derivative market is different from the spot market. Okay. So when you buy shares of, say, some company, okay, say you buy shares of Reliance Industries, okay, what happens is that you are paying for the shares today and you will get delivery on the T+1 day, right? So this is the spot market, right? Because immediate delivery and immediate payment. But if you are buying a futures contract of that stock, okay, then that contract will be settled on some future date, which is typically 1 month away or 2 months away or 3 months away. So that is a derivative transaction. So derivative trading does not require full cash payment on the trade date. This is very, very important. And this is the reason why derivatives are so popular among retail investors. Because when you buy or sell, buy a futures contract of some company, okay, instead of buying the shares, if you buy a futures contract of, say, Reliance or some other company, then you need not make the full payment of the share price today. Rather, what you simply pay is something called margin money, okay, to the broker. So what is this margin and all? We are going to look into that, okay? But just remember that trading in derivatives does not require full cash payment on the trade date itself. So which are the commonest types of derivatives? They are the forward contract, futures contract, swaps, and options. So now let's look at all these contracts one by one. So the forward contract. What is this forward contract? It is the earliest form of a derivative contract. Okay. This is the oldest derivative contract. Okay. Can I take questions and answers later? Would that do? Because
sure, ma'am.
Because I am finding it difficult to look at the chat while I am talking.
Yeah, ma'am, you can complete your presentation and in the last we can take all the questions.
Sure. So I will just go with the flow of the presentation
Sure,
and then we can take Q&A at the end. Okay.
Sure, ma'am. Yeah.
Right. Yeah. So the forward contract is the oldest form of a derivative contract. Why was this contract created? It was mainly to protect the farmer from the risk of falling agri-commodity prices. So you may have read in the news, recently that there was some problem with onions, right? And government has now banned the export of onions because the prices went up too high and all that. But many times we find that, the opposite can also happen. Many times when there is a bumper crop of some commodity, then what happens is that the prices of that commodity or that food grain, they come crashing down. And then the farmer has to sell them at a very, very low price, and he's not even able to recover his cost, his cost of seeds and the cost of tilling the land and everything. So the forward contract was created mainly to protect against the farmer, right? So let's take the example of a wheat farmer. He's planting his crop in November and he expects to harvest 400 kilos of wheat in March. That is his expectation because that is how much his field can produce. Now tell me, what is the risk to which this farmer is exposed to? Now, naturally, the farmer's risk is that the wheat price may fall because he's planting the crop in November and the harvest will happen in the next March. So over these 4 months, it is quite possible that, there could be a bumper crop of wheat. And if there is a bumper crop, then we all know that the price really goes down. So the risk to the farmer is that the price may go down substantially by the time his harvest is done. And on the other hand, let's say there is a company, somebody like Britannia, okay, which makes biscuits and confectionery items. And this company requires 300 kilos of wheat for its operations. Now, what is the risk to which this company is exposed to? Now, naturally, for the company, the wheat is a raw material, right? So the risk for the company is that the wheat price can go up. And you know that what happened after the Russia and Ukraine war broke out, right? What happened when the war broke out? The wheat prices went shooting up. Why? Because both Russia and Ukraine are big producers of wheat, right? So the moment the war broke out, wheat prices went shooting up. So the company doesn't want to take the risk of wheat prices shooting up, right? And farmer doesn't want to take the risk of wheat prices going down. So what they can do, they both can enter into an agreement, okay? This kind of agreement is called a forward contract. And under this contract, the farmer agrees to sell 300 kilos of wheat to the company on 25th March because he expects that his entire crop will be harvested by 25th of March. So farmer agrees to sell 300 kilos of wheat to the company on that date at a price of 22 rupees per kilo. Now, this kind of contract is called a forward contract. Why? Because they are agreeing upon the price today itself. At what price the sale will happen, they are agreeing on the selling price today, but the actual delivery of the wheat will happen only on 25th of March. Now, this agreed price of 22 rupees per kilo, this is known as the forward price. And the date of settlement of the contract, that is 25th March, this is known as the maturity date or expiration date of the contract. Now, remember one very, very important point is that this forward contract is binding on both the parties. Binding on both parties means it is obligatory for the farmer to deliver 300 kilos of wheat on 25th March, and it is obligatory for the company to pay 6,600 rupees to the farmer on receiving the delivery. That means what? Neither of the parties can escape their obligation. So suppose, let's say they have decided on a price of 22 rupees. Okay. Now let's say we come to 25th of March and let's say over the next 4 months, what has happened is that between November and March, let us say there has been a lot of hailstorms and unseasonal rain and everything. And because of that, the wheat crop everywhere in India has got spoiled. And the crop has got spoiled and therefore there is shortage of wheat in the market. Now, if there is shortage of wheat in the market, then naturally the spot price, that is the market price of the wheat in March, is going to be much higher. So let's say the market price of wheat in March, it has gone to 28 rupees. Okay. Now, can the farmer escape his obligation? Can the farmer tell the company that I am not going to deliver you 300 kilos of wheat because I have sold it all in the market at a higher price? He can't do that. Okay, because he has agreed to deliver the wheat at 22 rupees. So farmer cannot avoid his obligation to deliver to the company. And let's look at a different situation. Let us say that year there was a bumper crop of wheat and therefore the market price of wheat actually went down to 18 rupees a kilo in March. Okay. So the price in March became 18 rupees a kilo. Now, can the company tell the farmer that we are not going to buy wheat from you because in the market the price is much cheaper? The company cannot do that, right? Because the company is bound to buy the wheat from the farmer itself, right? So the contract is binding on both the parties, right? So that is the case of the contract. But there is a possibility that either party may default on its obligations. Okay. So for example, okay, suppose like we said that there were a lot of hailstorms and let's say that much of the farmer's crop has been destroyed because of the hailstorm. Now the farmer had promised to deliver 300 kilos of wheat to the company. But so let's say because of the hailstorms or because of unseasonal rains, let's say the farmer's field could produce only 100 kilos of wheat. Then what will happen? The farmer has failed to deliver this. Okay. So this could adversely affect the company's operations because they relied on the farmer supply of wheat. Okay. And similarly, if the stock price, wheat price actually falls sharply to 18 rupees, the company may try to avoid taking delivery. So although we say that actually, neither both parties are bound by the contract, in real world, in the real life, either party may try to escape from their obligations. And when they try to avoid their obligations, this is known as default. So the problem with forward contracts is that they are prone to counterparty default. Counterparty default means there is a chance that the counterparty may not fulfill their obligation. So in forward contracts, the possibility of counterparty default is always there, right? So because of this problem, the forward contracts gradually evolved into standardized contracts known as futures contracts. So gradually what happened is that these forward contracts came to be replaced by something called futures contracts, and these futures contracts started being traded on a common trading platform known as the futures exchange. So in the early days, we are talking about like 1600 AD, 1700 AD, in those days, there was no exchange as such. So all these forward contracts were negotiated by the parties between themselves. Okay. So this kind of a market where, where the contracts are negotiated directly between two parties, we call it the over-the-counter market or OTC market. So what is the special feature of an OTC market? Here, the buyer and the seller, they interact with each other directly and they negotiate the contracts with each other directly. And the payment and the delivery also happens directly between the parties. So in the early days, there were no exchanges. But gradually what happened, as the trading as all these activities increased, all these parties, they felt that we should have a common platform where, all this trading can happen, and this came to be known as an exchange. Okay. So gradually what started happening is that these forward contracts, all the terms and conditions got standardized. Okay. And they came to be called futures contracts, and they started being traded on the exchange. And then to make life simple, what the exchange did, that each exchange set up its own clearing house. So what is this clearing house? This is an entity which supervises the settlement of the futures contract. And the clearing house offers guaranteed settlement of the futures contracts in return for a small payment from both buyer and seller, which is known as the margin payment. So what is the job of the clearing house? It is to ensure that the buyer pays the amount to the seller and the seller delivers the asset to the buyer. And to ensure this, and if either party defaults, then the clearing house steps in and it makes good to the other party, right? And in return for this guaranteed settlement, the clearinghouse collects margin from both the parties. Okay. So that's how the forward contracts came to be converted into futures contract. So the futures contract is a modern day version of the forward contract. And today it is actively traded all over the world. Okay. Now we come to the third derivative, which is known as the options contract. So what was another problem with the futures contract or the forward contract? So although the futures contract eliminates the risk of counterparty default, it locks in the farmer's selling price and the company's purchase price at 22 rupees per kilo. Okay. So the problem here is that both farmer and company are obliged to sell and buy at 22 rupees per kilo. So if the market price of wheat is higher in March, let's say if the market price is 30 rupees, the farmer can't take advantage of that because he's bound to deliver the wheat to the company at 22. And similarly, if the market price has slipped to 18 rupees, again, the company can't take advantage of the cheaper wheat because the company is forced to buy it from the farmer at 22. So the farmer may desire a contract that allows him to sell the wheat to the company at 22 rupees, but also gives him the freedom to sell to another party at the market price if the market price happens to be higher than 22. And similarly, the company may also want a contract that allows it to buy wheat from the farmer at 22, but also gives it the freedom to buy from another party at the market price if the market price happens to be lower than 22. So these kind of contracts that give the buyer of the contract some freedom, some flexibility, they are known as options contracts. So you remember the forward contract is totally inflexible. There is no flexibility at all to buyer and seller, but the option contract offers some flexibility. It offers flexibility to the buyer of the option. So what is an option contract? So there are two types of options, a call option and a put option. A call option is a contract that allows the holder of the call the right to buy the underlying asset at a fixed price on or before the expiration date of the contract. And on the other hand, the put option is the opposite of that. A put option is a contract that allows the holder of the put the right to sell the underlying asset at a fixed price on or before the expiration date of the contract. So now you tell me in this example, which option should the farmer and the company buy in this case? What kind of option should the farmer buy? Let us say. Any idea? Yes, most people are right. The farmer will buy a put option. Absolutely right. Farmer will buy a put option. Why? Because what is the farmer trying to do here? The farmer is trying to make sure that he's able to sell the wheat at 22 rupees per kilo, but he also wants the freedom to sell it at a higher price if the market price happens to be higher than 22. So a put option will give the farmer the right to sell the underlying, that is the wheat, at 22 rupees on or before the expiry date of the contract. But if the market price happens to be higher than 22, what will the farmer do? He will not exercise his put and he will prefer to sell it in the market. On the other hand, what will the company buy? The company will buy a call option. Why? Because the company wants to make sure that it is able to buy wheat at 22 rupees, but it also wants to make sure that in case the market price is lower, then it need not buy the wheat at 22. In fact, then it will buy it at the lower price in the market. So the company will buy a call option, whereas the farmer will buy a put option. Right? So that is about options. And now we come to the fourth type of derivative, which is a sophisticated type of derivative. Now, the swap is something which retail investors are not very familiar with. Why? Because this type of contract is mainly used by financial institutions and companies. Okay, so there are basically many kinds of swaps, but the commonest type of swaps are interest rate swap and currency swaps. So let's quickly look at an example of an interest rate swap. What is an interest rate swap? Okay, so let's say there is a company, okay, some company which has issued bonds maturing after 10 years. Okay, so basically the company, what it has done, it has borrowed money from the public by issuing 10-year bonds, which carry an interest of 9% per annum. And this 9% is a fixed rate, right? So they will pay, the bonds will pay 9% coupon for 10 years every year till their maturity, right? So a company has issued these kind of bonds, right? But let's say that the company actually feels that interest rates may start declining next year. Okay, so as of now, let's say the company has issued bonds today and today interest rates are high. So company had to offer a coupon of 9%. But the company knows that sooner or later, maybe next year, interest rates will start declining. Okay, but the bonds which the company has issued are fixed rate bonds. That means their coupon is fixed at 9%. So even if interest rates come down next year, the company will still be paying 9% to the bondholders, right? So company wants to take advantage of falling interest rates. So what it can do, it can enter into an interest rate swap with a bank. Okay. And under this swap, so what is a swap? A swap is basically, the meaning of the word swap is an exchange. So an interest rate swap is simply an exchange of interest rate. Okay. So what it does, it enters into an interest rate swap with a bank, under which the company receives a fixed rate of 8.5% per annum from the bank and pays the bank a floating interest rate linked to MIBOR. So what is MIBOR? MIBOR is the benchmark of floating interest rates, right? So always remember, under a swap, one party will be paying something, other party will be paying something else. So in this case, the company pays to the bank a floating interest rate, which is linked to MIBOR, and the bank pays to the company a fixed rate of 8.5% per annum. Now, what happens if the rates actually start declining over the next few years? What will happen is that the MIBOR will be lower and lower. So the company is under an obligation to pay MIBOR, right? So as the MIBOR keeps declining, the company will be making lower and lower interest rate payments to the bank, but the bank will continue to pay a fixed rate of interest of 8.5% to the company. Okay, and by this kind of arrangement, the company will be able to reduce its interest rate burden on the bonds issued by it. Okay, so this is an example of an interest rate swap. Now we will not go much into this kind of swap because it is not traded on the exchange. So as I said earlier, there are two kinds of markets, right? There are two kinds of derivatives. Okay, so one are the derivatives which are traded in the OTC market or the over-the-counter market, and the other derivatives are those which are traded on an exchange. So the swap is the first kind of derivative. It is traded on the OTC market. And again, it is a contract which is mainly used by financial institutions and companies. So retail investors like us, people like us, we don't have much to do with this swap. Okay, so let's understand where all these derivatives are traded. So the forward contracts, the first contract which we discussed, the first derivative, the forward contract, it is traded in the over-the-counter market. Because as we said earlier, why was it created? It was mainly created for the farmer to hedge his own risk, right? So forward contract is basically traded, or it is negotiated between two parties. They decide among themselves what are the terms and conditions of the contract, and they agree to fix the date on which they are going to buy or sell, etc. So it is traded in the OTC market. What about the futures contract? The futures contract, as we said, it is basically a standard contract with standardized terms and conditions. Okay, standardized terms and conditions, as in on which date the contract will mature, at which location the delivery will be made. Okay, and what is the exact quantity that will be delivered, what is the quality of the commodity that will be delivered. So all these conditions are predetermined. Okay, and who decides all these conditions? It is the exchange, because these futures contracts are traded on the exchange. So the exchange decides all the terms and conditions or the contract specifications. The third kind of derivative, which is the swap. Again, this is a contract which is traded in the OTC market. That is, like in the earlier example, we talked about the company and the bank. So who decides the terms and conditions? It is the company and the bank. They themselves decide all the terms and conditions. So it is traded in the OTC market. And what about options? So options could be traded both in the OTC market and exchange. Okay, so again, there are some kind of options like equity options, okay, which are mainly traded on the exchange. But there could be some other options such as currency options, okay. They could be traded both on the exchange and in the OTC market, right? So depending on what kind of contract it is traded either in OTC or in the exchange traded. So again, all these derivatives, we said earlier that derivatives are available on different asset classes, right? I said that they are available on metals, on agri-commodities, on financial assets like equities, currencies, bonds. So depending on what is the underlying asset, the derivative could be either exchange traded or OTC. So when you look at equity linked derivatives, that is equity futures, equity options, then these kind of derivatives are mainly traded on the exchange. Okay. They are mainly traded on the exchange. What about currency derivatives? So currency derivatives are traded both on exchange and on the OTC market. So currency futures and currency options, they are traded on the exchange. So if you look at India, okay, so in India, we have currency options and futures which are traded on NSE and BSE. So they are traded on the exchange. But there are also other kinds of derivatives like currency forwards, currency swaps. Okay, these are traded in the OTC market. These are traded between banks and corporates, or only banks, right? So they are traded in the OTC market. What about interest rate? So in India, we have things like interest rate futures and interest rate options. Okay, these are traded on exchange, right? They are available for trading on NSE, BSE and all that. But what about interest? Then there are again some kind of interest rate options or swaptions, okay, or interest rate forwards. They are traded in the OTC market. And then what about commodities? So commodity futures and options, they are traded on the exchange, whereas again commodity swaps, okay, commodity forwards, they are traded on the OTC market. And what about credit derivatives? So credit default swaps and CDOs, they are all basically OTC derivatives. You may have, watched the movie The Big Short, and you may have heard about things called CDS, CDOs. So they are all basically OTC derivatives, right? So depending on the asset class, there are different, where they are traded, whether they are traded on the exchange or the OTC market. That depends on what is the underlying asset class. So now let's take a look at the global trading volume in exchange traded derivatives. So there is an association known as Futures Industry Association, FIA, that is an association of futures exchanges all over the world. Okay. And they regularly publish data on the trading volume of different kinds of derivatives in different countries on different exchanges. So basically, if you look at their data from 2012 to June 2023, okay, what do you find? So there are different kinds of derivatives which are traded on exchanges. So there are equity derivatives, interest rate derivatives, energy derivatives, metal, commodity derivatives, currency derivatives, and so on. So if you look at all these, how the trading takes place in all these kind of derivatives, what do you see? So more than 60% of the trading volume in exchange traded derivatives is accounted by equity derivatives. So equity derivatives, equity futures, equity options, they have the largest trading volume among all the exchange traded derivatives. Okay. So coming to, so the basically, if you look at this slide alone, you will understand what is the significance of equity derivatives, right? Because across the globe, and this is global data, right? This is not India's data. This is global data from futures exchanges all over the world. Okay. You find that most of the trading is in equity derivatives. Now coming to India, okay, when were equity derivatives introduced in India? So way back in the year 2000, when SEBI gave permission to NSE and BSE to start the trading of index futures. So that index futures were launched for the first time in 2000, and then they were followed by stock futures, index options, and stock options in the year 2001. Okay, so all these original contracts, they had a monthly maturity. Okay, so they had like 1 month, 2 month, and 3 month contracts. Okay, but recently from 2016 and 2019, exchanges have introduced weekly contracts as well. So now there are weekly options, bank nifty, nifty options, and all that, right? So these are available for weekly maturities as well. So let's discuss the features of equity derivatives trading in India. So basically all the equity derivatives trading in India, they are basically exchange traded contracts. So somebody had asked a question is whether, these are traded in the OTC market. So I will say that most of the trading in equity derivatives, it happens on the exchange. Okay. Because, and I think hardly anything would be traded in the OTC market. So what could be traded in the OTC market is could be some derivatives on unlisted shares of unlisted companies and all that could be trading in the OTC market, but again the data for that is not available in the public domain, so it is very difficult to say whether there is any OTC trading happening in equity derivatives. Okay, so I would say that most of the trading here is on the exchange. And obviously that the moment it happens on the exchange, it is screen based anonymous trading platform, right? And then the other important feature is the guaranteed settlement. So whatever derivatives are traded, equity futures options which are traded on the exchanges, their settlement is guaranteed by the clearing corporation, right? And these are all very highly liquid derivatives. So typically there would be some 200 stocks, etc., on which futures and options are available. And before allowing the trading of futures and options on a particular stock, there are many stringent conditions which the stock should satisfy. And only stocks which satisfy all those eligibility criteria, only such stocks are allowed for trading of futures and options on the exchange. Okay. And there is high liquidity. So we will look at that. Different categories of participants are there. And this segment has grown tremendously over the past 20 odd years. Okay. So since trading started in 2000, a lot of trading. So let's look at the traded volumes for equity derivatives and cash segment. So I have only taken the figures for the last couple of years, 2021-22 and 22-23, and I've looked at the NSE and BSE, because these are the two exchanges where most of the trading happens. Okay, and what I have in the first column, I have the total equity derivatives turnover, and then in the second column, I have the cash segment turnover. Cash segment, as you know, it is the buying and selling of equity shares, right? So if you look at the turnover, compare the turnover of the equity derivative segment and the cash segment, what do you find? In NSE, at least, the equity derivatives turnover is like 100 times. In 21-22, it was 100 times the turnover of the cash segment. And in 22-23, it was more than 200 times the turnover of the cash segment. Okay, and even in the BSE, you can see that the equity derivatives turnover is several times that of the cash segment. So what we can infer from this slide, we can conclude that the equity derivative segment is much more liquid than the cash segment, because huge amount of trading happens there, right? So that's an advantage. So if something is very liquid, how is it an advantage to the investor? Because then buying and selling something, getting in and out of the market becomes very easy if it's a liquid asset. If it's an illiquid asset, then getting in and out of the asset can be very challenging, right? So for example, real estate is an extremely illiquid asset. Okay, suppose you have a house and you want to sell it, you can't do it in a jiffy, right? It will take at least a few months to find a buyer and then to conclude everything, right? Equity derivatives market, on the other hand, is extremely liquid. You can see by the way, all these numbers I've written here, they are in rupees crore, right? All these numbers on the slide, they are in rupees crore. So you can imagine what is the traded volume. Okay, so huge trading happens on the equity derivatives segment. So who are the participants here? Okay, so again, this data is SEBI published data. I've taken it from the SEBI monthly bulletin for April 2023. So basically, the investors here can be divided into 5 categories. They are banks, mutual funds, foreign portfolio investors, and proprietary traders. Okay, what do you mean by proprietary traders? So basically, they could be brokers or people trading with their own money. So proprietary traders, basically they are the proprietary trading desks of the big brokers, right? And there is another category called others. So the others category would include retail investors, HNI investors, corporates, and all these other things, people who are left out from all these categories. And what do you find here? Very interesting. So again, I've given comparative numbers for last 2 years. So what do you find here, that the share of the proprietary traders is more than, you can say, more than 50%. Okay. Whereas the share of others is almost 40%. Others, that includes the retail investors and corporates and HNIs and all that. So share of other investors is nearly 40%. That of proprietary is more than 50%. And even FPIs, that is the foreign investors, they have a very decent share of nearly 8%. Whereas mutual funds have almost zero share in the equity derivatives market, and banks again have zero share. Okay, so our equity derivatives market is very different from the market in other developed countries like the US, right? Because if you see in the US, most of the trading in equity derivatives will be done by the institutions, like the big investment banks and all that, and retail investors will hardly have any participation in the equity derivatives market. Okay, but in India, the picture is very different. In India, what you can see, the proprietary traders have the lion's share, and even the retail investors, HNI, they have quite a big share. But the domestic investors, that is the DIIs, they have hardly any share in the equity derivatives market. Okay, so that is regarding the participation. So why do all these people trade in equity derivatives? Why do they participate in the equity derivatives market? Okay, so obviously the derivatives, right from the forward contract, they were created for the purpose of hedging and risk management, right? So in the first case, we saw that the case of the retired person, Mr. Sharma, and we said that he was worried that the market will fall next month because of the election results, and if the market falls, then his portfolio will suffer, right? So he wanted to protect his portfolio against his equity portfolio against the risk of falling market, right? So he was basically trying to hedge his risk. So risk management is one very important reason why people use derivatives, right? And the other reason why retail investors are so interested, we saw that in the earlier slide, we saw that the share of retail investors, or not retail, but non-institutional investors, right? Institutional investors are all your mutual funds and foreign this thing and all that, but the share of non-institutional investors, that's nearly 40%, right? So why are they so interested in trading here? Though that is because of speculation, because I said earlier that, when you buy or sell a futures contract on some stock, or when you buy or sell a call option or a put option, when you buy a call option, let us say, or when you buy a put option, you don't have to pay the entire price of that stock, right? You have to pay only a certain percentage. So when you buy a futures contract on say Reliance, you don't have to pay 2,500 or 2,600 or whatever is the price of Reliance. You only have to pay a margin for the futures contract. And similarly, if you buy a call option on some company shares, then you don't have to pay the entire stock price. You only have to pay a small amount, which is known as the option premium. And by paying these small amounts, which are only a fraction of the entire value of the share, you get control over a huge number of shares. So this is known as the power of leverage. Okay, this is known as leverage, because by paying 10 rupees, for example, you get control over an asset which is worth 100 rupees, right? So, or by paying 20 rupees, you get control over an asset which is worth 100 rupees. So you are leveraged 5 times, right? So because of the power of leverage, the equity derivatives are very, very popular among retail investors, because the retail investors typically they have less money. Okay, so by investing less money, if they can make big profits, then naturally they would love to do that. So speculation is another important motive, speculation, because of the leverage nature of the contracts. That is another reason why people trade in equity derivatives. And the third reason is something called arbitrage. Now, what is this arbitrage? Arbitrage is simply trying to make a small amount of profit out of the incorrect prices. Okay, so typical example of arbitrage is that, suppose a share is trading on the NSE at 100 rupees, and the same shares are trading on the BSE at 99 rupees. So what would somebody do? Somebody could buy on the BSE at 99 and sell on the NSE at 100. So this is arbitrage. Okay, so same arbitrage activity can be done using equity derivatives as well. Okay, so these are the 3 main reasons why people participate in the equity derivatives market. Now, somebody had asked some time ago, are there any risks associated with these derivatives? And of course, there are risks. There are a lot of risks, and the most important risk is market risk. Now, what is market risk? Market risk is the risk that, the market moves against you. That is, you have bought or sold some futures contract. Let's say you buy a futures contract on some stock because you believe that the stock price will go up. And in fact, the opposite happens. Let's say some news comes out about the stock. Let's say the company's results for the last quarter are bad. What will happen? Immediately, the stock price will tank. And because the futures contract is a derivative, okay, so if the stock price falls from say 100 to 80 rupees, then the price of the stock futures contract is also going to fall, okay, more or less by the same amount. So if you have bought the futures contract say at 101, and then the futures price falls to say 88, then you are in the dock, you have lost, let's say, 13 rupees, right? So that risk is known as the market risk that the market moves against your position. Okay, so that is market risk. And in case of derivatives, this market risk is amplified, it is intensified because of the leverage nature of the contracts. Because let us say you have bought one stock futures contract, but let us say the lot size of that contract is say 500 shares. So when you have bought one futures contract, it is as though you have bought 500 shares. So whatever loss you make, so suppose you have lost 13 rupees on that contract. So you have not actually lost 13 rupees, you have lost 13 into 500, which is say 6,500, right? So the risks are intensified because of the leverage nature of the contracts. And obviously the second risk is something called liquidity risk. Now, what is this liquidity risk? So I said earlier that these equity derivatives are extremely liquid, and so there is no problem trading them. And okay, but sometimes it could so happen that, sometimes it is quite possible that the trading might just dry up. The volumes may dry up in that particular contract. And if you have bought it and you are unable to sell it to somebody else, then what happens is that you are stuck with that contract. Okay, you are not able to get out of your position. So that is liquidity risk. And the third is execution risk. So this is very, very important when we talk about arbitrage, because in arbitrage, what happens is that we are buying one contract and we are selling the other. So it is very, very important that we should be able to do both these transactions simultaneously, right? Instantly. In the same instant, you should be able to buy and sell, right? So there is a risk of not being able to execute the transaction instantly, right? So that is an example of execution risk. Now, what is basis risk? That is something to do with hedging. When you are hedging and you are not able to, completely hedge your risk, some part of the risk is still left open. That is basis risk. And of course, there is always regulatory risk, right? What is this regulatory risk? The risk that, the government or the, SEBI or anybody may suddenly change the regulations, the rules and regulations, and then, that might affect your position and you might make a loss because of that. So all these are various risks that are associated with the equity derivatives. So before concluding my discussion, I'll just show an application. So this is just an example of how derivatives can be used. Let's say this company is holding stocks worth 1,000 crore, and but they are not sure of how the market conditions will be in the near term. So what are the alternatives available to this company? One, it can sell the stock today itself and invest the sale proceeds in some money market instrument, or it could sell futures on the stock to hedge its risk, or it could buy a put option to hedge its risk, or it could sell a call option, or obviously the fifth alternative is not to do anything. Okay. And just this table just shows that suppose after 3 months, the stock price is 900, okay, or 1000 or 1025, then all these alternatives, what will be the result of all these alternatives, right? What is the payoff from these alternatives? So it just shows what will be the payoff under different scenarios, right? So that is just to show how different types of derivatives can be used in a particular situation. Okay. So that is about the importance of derivatives and everything. So let's come to our subject for today, which is the the derivative certification exam, series 8. So for whom is this exam? Okay, this exam is for persons who are functioning as approved users and sales personnel of brokers of an equity derivatives exchange. So they need this exam is compulsory for such people. And what is the structure of this exam? So basically it is a computer based exam with multiple choice questions, and a duration is of 2 hours, and there is negative marking of 25% of the marks assigned to a question. So if it's a 1 mark question and you get it wrong, then you lose 0.25 marks. Okay, I mean there's negative marking of 0.25, right? And you require to score at least 60% to pass this exam. And once you pass it, you get a certificate which has a validity of 3 years. Now there's a fees of 1,500 for this question, for this exam, and it will have total 200 questions. Okay, so that's the structure of the exam. And who should be taking this exam? So all approved users, as we said, and sales personnel of brokers, and even students can take this exam. In fact, it is a very nice preparation for your MBA, or if you are doing CFA or any such course, then this is a very nice exam to take along with it. And any other individuals who are interested in gaining knowledge of securities operations and risk management. So what will you learn from this exam? So when you register, you will be given the textbook, and from the textbook you can know the basics of the Indian derivatives market, understand the difference between spot market, OTC, exchange traded derivatives, various trading strategies, and also understand the clearing, settlement, and risk management. So these are the various NISM certifications, and with that I conclude my presentation.
Yeah. So thank you, ma'am, for enlightening our audience about the nitty-gritties of derivatives market, especially focusing on equity derivatives. We also thank our audience for joining us and actively participating through answering the questions as you have been asking during your presentation. So I would request the candidates who are interested in NISM examinations that they can log on to our website, that is www.nism.ac.in, in case they have any queries about certifications, or they can also call at 8080806476. I will type the number in the chat box for your reference. So, so you can call at this number and in case you have any specific query. And those who wish for the presentations, our presentation has been live on LinkedIn also. So in case you want to revisit the session, you can go get it through the LinkedIn. So I thank everyone. Thank you, ma'am.
Thank you. Thank you for
Thank you, ma'am.
having me here.
Yes.
Thank you.